Tesla stock is down 20% year to date. They are reporting earnings next Wednesday, the 23rd of July, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the forecast, some important statistics, using my spreadsheet to calculate the intrinsic value of the company, looking at the risks of investing in Tesla, and revealing whether or not I am adding it to the YouTube stock portfolio. If we start looking at the financials and starting with the revenue, we're going to see that Tesla was growing substantially from 2020 to 2023, but since then, their revenue has been flat, and it is currently at $95 billion. So Tesla is a company that is currently struggling. If we take a look at their profit regarding net income reached $14 billion on December 2023. And it is currently at $6 billion. And free cash flow, the same. As we can see, it reached a peak of $8 billion in 2022, so even less than net income, and it is currently at $6 billion. As a consequence, their margins has suffered a lot, with gross margin being 27% 3 years ago, and it is currently 17%. Profit margin used to be at 15%, and it is currently at 6%. And free cash flow margin used to be at 11%, and it is currently at 7%. So looking at the financials, we can definitely see that Tesla is struggling. However, if we take a look at what analysts are expecting, they are expecting Tesla to recover and reach $140 billion in revenue in 3 years, and $3.70 per share in 2027. I have summarized here what are the main problems that Tesla has faced lately and why their financials are struggling. So number one is the intensifying competition in EV, because Tesla is not the only electric car company anymore. Companies like Ford, GM, BYD, and Rivian are now selling EVs. Number two is margin erosion due to frequent price cuts. As we have seen, their margins have suffered a lot. So to keep selling more cars, Tesla keeps lowering prices. This helps sales, but it also means Tesla makes less money on each car. Their profit margins have dropped a lot, and this worries investors. Number three is the execution risks and stalled new products. Their new projects, like the Cybertruck and the cheaper $25,000 car, keep getting delayed. Elon's distractions with other companies like SpaceX and politics have caused some concern among investors. And number five is the macro and policy headwinds. So high interest rates make car loans more expensive, so fewer people buy cars. Also, changes to the EV tax credits or new tariffs could hurt Tesla's sales. Despite all these problems, if the stock is selling cheap enough, this might be a huge opportunity to buy this stock. In order to find this out, I use my spreadsheet, which is a discounted cash flow net income model and tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. As a long-term value investor, I did a 7-year analysis with low, middle, and high assumptions. As you can see, the intrinsic value, according to my low assumptions, is $48 per share, middle $88, and high $148. And the stock is currently trading at $323 per share. This also means that if my low assumptions occur and you buy the stock today, you're going to make a negative 18.1% annual return on your money, middle negative 10%, and high negative 2.4%. So according to this spreadsheet, the stock is not selling very cheap. And therefore, according to the spreadsheet, this stock is selling very expensive right now. And if we take a look at some ratios, the current PE for Tesla is 184, the price to free cash flow is 152, and the price to sales is 10. Other car companies sell at a price to sales of 1, so it is definitely trading very expensive. Now, this spreadsheet does not take into account the balance sheet. And I will say that Tesla has an amazing balance sheet, as they have $37 billion in cash and $13.13 billion in debt. Finally, in order to answer the question of whether or not I am adding it to the stock portfolio, the answer is no, as I prefer to invest in companies that I believe are heavily discounted, such as Alibaba, PayPal, and SoFi. The best one so far is SoFi, as we have returns of over 200%. And I believe Tesla has a lot of problems and it is not selling at a sufficient discount in order to make huge returns. I hope you found this video valuable. Let me know what you think about Tesla stock in the comments, and I'll see you in the next one.